This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers at PWL Capital.
And this is episode 223. Welcome, everybody. Another episode. And for those that are watching on YouTube, yes, I'm in my new home office setup. Well, same home, different office.
I'm super jealous.
Just got out of the...
It looks very nice.
Oh, it's all in the pot lights. These new pot lights that are out these days are unreal.
It looks great. Just having a nice little room. My setup's... I won't tell you how crazy it is. It's a strange room.
I got James's old bedroom, so he's on the other room now. So I put in nice pot lights. I'm going to do some nice soundproofing on the back wall, so it will get better, but it's nice to be in my own room. Oscar's not crazy about it up here, though, so that's why I want to see Oscar. No. So you know, Ben, I'm a fan of habits, and completely agree with Katie Milkman and other guests who have said that by saying you are something, you will do something and become something. So as you know, I got a Peloton a long time ago and just decided that I'm going to ride the Peloton every day that I'm home. So you don't even debate like which days of the week, you just do it. Anyway, so tomorrow, Friday, which when this drops will be last Friday, I'll be doing my 1,000th Peloton ride, if you can believe it.
Wow.
And I say that not for applause. Anybody can do it. It just shows the power of doing something every single day when you're home. Like the numbers just, I wasn't even paying attention. All of a sudden I get this email from Peloton saying it's coming up. So I'm going to try to do a live ride and maybe we'll get a shout out, which is kind of cool. And maybe some other our listeners will be there. And the other thing, you mentioned bundling in this episode. I don't listen to the trainer on Peloton anymore. I actually listen to a podcast. I'm bundling podcast listening with the training experience, which is cool. Have you watched yet on Netflix the new series called Eat the Rich, the GameStop saga?
No.
Are you going to watch it?
Maybe.
You're skeptical.
No, I'm not skeptical. I don't think that my wife will be interested, and I usually only watch Netflix for like the 1 hour that we're sitting together on the couch at night, so...
Okay, that's pretty good. Anyways, most people are aware of the whole GameStop saga that happened in late 2020 that led to the massive rise in the price of GameStop shares. I've heard the story a number of times. Like Barry had the author Spencer Jacob, the guy from the Wall Street Journal who wrote the book, The Revolution That Wasn't. So I knew the story, but I didn't have a full appreciation like I think you do for Wall Street Bets and the characters behind this. I didn't really connect as well to all that. Anyways, this whole thing comes to vibrant life in this very wacky little mini-series. 3 episodes, 35, 40 minutes each. It's funny, it's funky, it's interesting, it's accurate, like how things happen. The timelines are very well explained. You learn about the character Roaring Kitty. Like, you know about Roaring Kitty?
Oh, of course.
Anyways, the whole thing's wacky. And this groundswell to basically put the screws to hedge funds and cause this short squeeze. How short squeezes work, they do a very good job of explaining that. The role Robinhood played. When Robinhood disallowed their customers to buy more GameStop, what's the story behind that? And that links to Citadel, and that links to Melvin Capital. Elon Musk tweeting in the middle of it all caused the price to go up even more. All these concepts are really, really well done. It's quite comical to watch. Like this Roaring Kitty is just this crazy character, and they show the video clips of him. And the amount of money that was lost is wild. Like $20 billion was lost in this squeeze.
Insane.
It's insane, but it's a pretty engaging, entertaining video of a pretty crazy story.
Does it talk about who came out on top?
They have actual people in there who did make a fair chunk of cash. So they have real people that, like real Reddit watchers that piled onto this and did make some money, yeah. There's a number of characters that they interviewed through the story.
Interesting. That whole episode killed Wall Street Bets. That used to be one of the subreddits that I would go on every day because it was interesting and funny. But then the number of people, what are they called, members or whatever of the subreddit, swelled. It was like well below a million, but it was increasing, it was growing. And then when this thing happened, it went up, I don't know, like 6 million or something. And then I just stopped. It just got too, I don't know, stopped being interesting.
So you went before the popularity hit.
Yeah, because it's like super geeky finance humor with a kind of edginess that I find funny.
And then it just became this buried.
I couldn't tell you. I never go in there anymore.
Okay.
Because it started being.
Were you there through the episode, through the price taking off and people just buying whatever they could, buying more and more and more?
Yeah.
And that coincided with Robinhood and the ease of trading. Wow. I didn't realize you were that active in there.
I was active. I've read the posts, but
that's what I mean, but lurking.
Yeah, lurking, exactly. But it changed the whole subreddit when all this stuff happened.
So November is Financial Literacy Month in Canada. In the US, I didn't know this, April is Financial Literacy Month. But in Canada, it's November. And as you discussed back in episode 217, there's certainly a great need to increase our collective financial literacy. So in November, in the Us episodes, we're going to be quickly reviewing 10 books that we think can help improve anyone's financial literacy. And then in the store for Financial Literacy Month, in the month of November, if you spend $30 in the store, you'll get 50% off a deck of Talking Sense cards. So the cards are already pretty affordable. Now they're really affordable. And you get the free socks and cozy with it. So I think Angelica's going to start this sale right away and not wait for November 1st, but it goes until November 30th. The store can be found at rationalreminder.ca. I had someone reach out to me, Ben, on LinkedIn and ask for an update on the crypto series.
Yeah, I feel bad for kind of just letting it die without us saying anything in the last couple of episodes. We had one more guest lined up, and they ended up having to cancel and wanted to reschedule for sometime in October. So we have not rescheduled yet, but the intention was to have that final episode and then finish with one more episode with just us kind of summarizing everything. So I still have to book that final guest, but then in the interim, I also found one more person that I want to talk to. Two more, actually. Two more, because there's one more guest and one. So you remember our very first episode in the crypto series was with a Rational Reminder listener who was a software engineer, and he'd written about blockchains and from a software engineer's perspective, what they're actually useful for. So he was our very first episode. We have another Rational Reminder listener who is also a software developer and is working on like Ethereum related projects. So they're very much in the pro crypto camp, but also a dedicated Rational Reminder listener. Like so I think it will be interesting to talk with them in an episode to kind of get their take on the crypto series from that perspective. Just to see if there are any kind of blind spots because we did have a lot of skeptical perspectives. So I just want to hear from somebody who's working in there. Like we kind of heard it with Ari Jules in the last episode that we did publish, that there's maybe a different perspective if you're working in the space than if you're looking at it from the outside in. So anyway, so there's those two more guests and then the one episode with a listener to kind of review the series. And then we will cap it off with an episode at the end. But all of this timeline is kind of uncertain right now because I still have to book those last two guests. And I told the listener that I want to talk to them after we've published the final episode. So anyway, but it's not dead. We will finish the series. It's just things got a little shaken up because of the one guest cancellation, and I haven't gotten it back on track yet.
Yeah. And we got a pretty busy fall.
Yeah.
Speaking of crypto, and I didn't put this in the notes, but I watched that new feature film, I guess you could call it, called Coin, which is basically a story, the Brian Armstrong story, the founder of Coinbase. So I rented that on the weekend on YouTube. I think it's $5 on YouTube, and I watched it. Do you watch it?
Are you trying to bait? Are you trying to bait me into giving you perspective on it?
No, not at all. No, I mean it's an interesting story. He seems like a really nice guy with lots of decent intentions. I've told other people that asked me what I thought of it. I learned a lot about him, learned a lot about Coinbase. But having gone through, 17 episodes of the crypto series, it would have been really nice to have some counter arguments just to kind of challenge some of the basic beliefs and statements. That would be my main feedback, but it was well done. But it's a feel-good movie about Brian Armstrong and crypto, which is okay, but I would have liked more diverse views included. But it's a professional, like it's a real movie. It's a real thing.
Yeah. I haven't watched it. and I'm not really comfortable sharing the reviews that I've read about it, but they were not very positive.
Right. Oh, I know. I saw the reviews. But I'm kind of glass
basically
half full. But
propaganda promoting Brian Armstrong, and yeah.
Next idea. I'm in London in the middle of November, London, England. So I'm looking to set up a happy hour for any listeners or people that might be interested in just meeting up and chatting. If you're interested, drop me an email. This would be kind of cool. So far, I think we have half a dozen people that want to
really
meet up. And
wow.
Yeah,
when are you going to London?
LinkedIn and Twitter.
When is it?
Middle of November. So it'll be like probably the 15th-ish. Tuesday the 15th is the date we're looking at. So it'll be like after work sometime. I'm presuming some pub somewhere, but I'll see if there's any interest first.
What are you doing in London?
Presenting at a conference.
What are you presenting on?
I love that surprise. You?
No, it's not surprise. I'm just curious.
I'm presenting on the impact of Rational Reminder on our business and how that's helped us, and also on our succession plan that we've talked about.
Interesting. Okay, cool.
Yeah. Anyway, so in this week's episode, Ben, you presented the goals research you've done, which is beautiful. We talk about the Next Millionaire Next Door, the book, and discuss that. And at the end, there's some pretty meaningful, impactful messages. And at the very end, there's one extremely meaningful message that we got from a listener. So pretty powerful stuff at the
those were all
I'm saying they all were, but deep. The last one, they're all pretty impactful. I agree.
Yeah. Yeah, we finally did the long-awaited goals survey results. I think it's pretty cool. Although,
that's a mandatory takeaway for everybody. Absolutely, when that paper is available, mandatory.
Yeah. It's that was a neat exercise to go through, and I say it in the episode, but thank you again to people spent an hour of their time at least, because they probably thought about it outside of actually having the browser window open to fill out the answers. To respond to that. 310 people. It's a lot of people's time.
All right. And with that, let's get to the episode. Welcome to episode 222. And I must say, Ben, I am super excited for this topic. I think this is just a phenomenal piece of research that you've done.
I don't know. I feel underqualified to report on the data that we've collected, because we collected some really cool data. Thank you also to the people who participated in the survey. We had, I'll talk about the data in detail, but we had 310 people who spent on average about 50 minutes each completing the goals survey that we asked people to complete. So that's a
serious commitment of time. It's incredible.
There's a lot of man hours that went into this. Anyway, so we have this really cool data set. I feel like I'm underqualified to report on it. Because of that, we have actually sent out the data to a few people who are much more qualified, just to say, is there anything in here that you think we could tease out that we've maybe missed? So maybe some more interesting stuff comes out of that. But for now, I'll report on what we've found in the data. Okay.
Well, what you found, I love it. I just think I just love the output. I love the thought that went into this. And I think it's going to have a meaningful impact on a lot of people.
It's a really cool project. So, I'll back up and introduce what we're talking about for anyone who maybe doesn't know. So we did this goals survey. The idea being that generating relevant objectives for financial planning in this case, based on values, information, and knowledge is a necessary part of any decision, but it's something that people aren't very good at doing empirically. And that's been studied. People are not good at generating a comprehensive set of the objectives that are important to them. And of course, as financial planners, it's super common for people to sit down with clients and say, what are your goals? But knowing that people are empirically deficient at identifying what their goals are, it's a bit problematic. One of the big studies on this is from Bond, Carlson, and Keeney, a 2008 paper. And they find in 3 empirical studies that participants consistently omit nearly half of the objectives that they later identify as personally relevant. Half, yeah. And that the omitted objectives were perceived to be almost as important as those initially identified by the participants. And there's another interesting data point from a Morningstar study that I'll get to in a second. So those findings suggest that decision makers are deficient in using their personal knowledge and values to form objectives for the decisions that they face. In financial planning, I think this is a pretty significant impediment for people who are giving financial advice, or likewise for somebody who's trying to make a financial decision on their own without financial advice. Objectives well, I guess it's probably true in any context, but I think I know in financial planning, objectives will often be conflicting. So if you sit down and build a financial plan around a set of objectives that are incomplete, you may be making yourself worse off if you're not working, or you may be moving away from some other objectives that you would have thought to be important but missed in the identification process. So I think, like I said, it's probably true in any context or most contexts, but in financial planning, I know that there are always trade-offs and conflicting objectives. So there's another paper from Bon, Carlson, and Keeney. That's a 2010 paper. And they suggest that not thinking broadly enough about the range of relevant objectives and not thinking deeply enough to articulate every objective within the range that is considered are the main impediments to generating a comprehensive list of objectives. And in that paper, they offer a few interventions, like ways that you can deal with that problem. So the steps they suggest taking are generating a list of objectives. So sit down and generate the list. We know that list is going to be deficient. And then the second step is to set a challenge of increasing the number of objectives relative to what was initially identified. So they looked at different numbers, but as a rule of thumb, they just say try and double it. Try and double whatever the size of the list was. So if you initially identified 3 objectives, try and identify 3 more. And then they also suggest consulting categories. And in this paper, they empirically test all of these different interventions. So introduce categories. So say for the objectives that you're setting, objectives will generally fall into these categories. And then that might inspire more objectives that were previously missed.
Right.
And the last step they suggest, after the first 3, and it has to be after the first 3, otherwise it can bias the objectives that you choose, is to consult a master list. Now, master lists don't always exist for decisions. And the whole idea of this goals survey that we did is that we wanted to see if we could create a master list by basically crowdsourcing financial goals and seeing if we could create a list, a comprehensive list of goals that people might have. This was sort of attempted in a 2018 paper from Morningstar. It's a nice paper. They had 318 people, so a tiny bit larger than our sample, but it was much less comprehensive. So all they did is basically step 1 of our survey, and they constrained it to your top 3 goals. Ours was very open-ended, and we gave, I'll talk about the prompts we gave in a minute. So anyway, this Morningstar study, they just said rank your top 3 goals, 318 people. They do replicate the usefulness of a master list in goal setting. They find that on average, 26% of their participants changed their top goal after seeing the master list. So that's pretty crazy, right? What are your top 3 goals? And then they say, here's a list of goals that other people chose. 26% of people changed their top financial goal after seeing that list.
Think about the implication for all those financial planning discussions that are going on all the time if you don't have the best possible goals for the individual.
Yeah. No, it is crazy to think about. And in this Morningstar sample, they found that 73% of people changed at least one of their top 3 goals after seeing the master list. So the vast majority of people were changing at least one of their goals, but the 26% changing their top goal, I find pretty crazy. Pretty crazy, but not unexpected after the other papers that we just talked about. So in that paper, they conclude that the Morningstar paper concludes that a master list may indeed be useful. The master list that they generate, and I think it's because of the way that the study was conducted, like their objective was not to conduct a master list. It was to see if a master list is useful.
Right.
But because their questions weren't super comprehensive, the list that they came up with, and I mean, we talked about this when we introduced this goals survey a while ago. The list they came up with, when I look at it, just doesn't look comprehensive, and it doesn't look like goals that I would tend to assess as sensible if I were giving somebody advice. So we wanted to make something more comprehensive. So what we did is built a survey with 3 questions. So kind of like the Bond, Carlson, and Keeney paper, or the suggestions that they have for generating objectives. So 3 questions. The first question, I'll read it. It said, imagine the life that you want to live and create a list of the financial goals that will get you there. These can be short-term goals and long-term goals, effective goals or statements. So this we drew from Eyelet Fishbach's work. Right. Effective goals are statements of a desirable state, not the means to get there, and they are abstract. For example, saving up a $10,000 emergency fund is a means, not a goal. The corresponding abstract goal would be feeling financially secure. So that was the first question. And then people wrote their responses, and then when they clicked next in the survey, that brought up the second question, which was the challenge. So it challenged them to double the size of their list. And then the third question presented the PERMA V model and a short description of what the model is. And we've talked about that in the podcast a few times, so I'm not going to go into too much detail on what the PERMA model is, but it's like a model for well-being. And we described very briefly what each of the categories are, and then asked people if that elicited any further objectives that they may have initially omitted. So 3 questions. And we'll talk about the effect of the questions as we go through the data. So we had 310 people, 49 minutes to complete the survey on average. 76% of the respondents were men, which is a lot, and wasn't ideal. But relative to our 95% male audience, we were pretty happy with the gender distribution. So 23% were women. The remainder were non-binary, non-conforming, or did not disclose their gender. But for the most part, respondents were either male or men or women. The majority by age were 25 to 34 years old. That was 138 of the 310. And then 96 people were 35 to 44. And then the rest fell on either side of that age distribution. But the majority were those really 25 to 44-year-olds. In terms of individual objectives, so there are 3 questions, but somebody could have, because it was open-ended, so somebody could have put, 6 objectives into question 1 if they wanted to. So in total, there were 2,394 individual objectives once we parsed out all the data. It's a lot of data. What we then did is went through all of that data and tried to identify overarching objectives that captured all of the 2,394 individual objectives. So we ended up with a list of 28 things, statements, objectives, goals, whatever you want to call them, that we could fit all of the underlying objectives that people had identified into.
Interesting. So you boiled it down, basically.
Boiled it down.
2,400 down roughly to 28.
Yeah.
Okay.
And it's not perfect, and I'll talk about what I think the limitations of what we've done are a little bit later, but I think it is pretty good. And at least of our sample, the 28 objectives that we've identified are fairly representative. But I also don't think we have a very representative sample for the broad population. I'll talk more about that too.
But the goals that come up with a list of goals, you delivered.
Yeah, and I think in terms of sample bias, we have a pretty interesting one because the majority of people who filled this out are podcast listeners. And if they've been listening for a while, they've heard all sorts of episodes about well-being and happiness and purpose and meaning and how that all relates to money. So I think the objectives that we generated with this exercise are probably biased in a pretty good way.
Can you think of any obvious omissions? Did anything come to you as you're going through the data?
What kind of omissions?
Just a goal that you thought might have been there that wasn't there? Did anything? I'm just curious.
I mean, the master list didn't exist. I didn't know what was going to show up on there. I don't know. we'll talk more about the objectives that people identified in a bit, but I want to talk a little bit more about the data. So the first question yielded on average 2.74 objectives. The second question added 1.92 objectives, so people didn't quite double their list on average, but kind of close-ish. And the third question produced an additional 1.4 objectives, which is also interesting. So 6.08 objectives on average per respondent. And those are six objectives based on the 28 categories. So people might have had 20 objectives, but those boiled down to 6 based on the categories. Does that make sense?
Mm-hmm.
Like a lot of people listed the same objective basically in a bunch of different ways. So we categorize that as one listed objective. Mm-hmm. Okay, so now I'll talk about some of the things that people identified as being important to them. The single most common objective, which was shared by 70% of respondents, 70.3% of respondents, was being financially independent or being in a position where work is optional. I think same kind of idea. So financial independence was hands down the most important. We did break this down by gender because we had the data, and it was interesting. The financial independence objective occurs more frequently for men at 71.7% of respondents than for women at 66.7%. And this is the aggregate data split out by gender. We also had it split out by age and by question. Talk more about that in a second. The second most common objective, it's related to financial independence, but I think it is distinct in some important ways, which is feeling financially secure. I think you could be financially independent without necessarily feeling financially secure, and you could also not be financially independent and feel financially secure.
Great point.
So that was the next most frequently selected objective, or objectives that fit into that category were most frequently reported, second most frequently. This one had a big difference in men and women. So 57.9% of men identified that as being important, whereas 68.1% of women did. So that's one of the biggest differences by gender. The biggest difference by gender was in the frequency of objectives related to travel, leisure time, and experience with family. So 59.7% of women had objectives related to that, whereas only 46.4% of men did. And then the other big gender difference was being generous with loved ones. So 33% of women identified that as being important, whereas only 23% of men did. We didn't report on the non-binary, non-conforming, or people who didn't identify their gender because there was only, I think, in total 5 that fell into those couple of buckets. But those data are included in the aggregate, the overall data. Just when we split it up by gender, those don't show up. In the age cohorts, there were also, and again, there are some sample size issues here because, like in the 18 to 24 bucket, I think the sample was 18 people, and then likewise in the older groups, there weren't a ton of people. So I didn't try and dig too much into trends there, but there were a couple that really jumped out. So in the 25 to 34 age group, 50% of people identified home ownership as being one of their primary objectives. But that one, so this is one of the cases where there was a very clear trend across the age groups. So that importance decreased pretty much monotonically down to 12.1% for the 56 to 64 age group.
Likely because they own a home?
That's what I figured. That's my guess. Like we didn't control for current home ownership in the data, but that'd be my guess. So it becomes less important because people are just more likely to own a home.
Yeah.
And that did include, though, not just buying a home. Like in that overarching goal, we fit in people who wanted to buy like their first home, but also people who wanted to upgrade a home or build or buy a dream home. So it's just like home ownership related objectives. But yeah, they became less important over time. Another one that jumped out as interesting by the age cohorts was the importance for having the ability to be generous with loved ones in the 25 to 30, and keep in mind that these two age cohorts were the biggest samples. So, I don't know, maybe there is something meaningful in here, but in the 25 to 34 group, 16.7% of respondents said that it was important to be able to be generous with loved ones. But in the 35 to 44 group, that almost doubles to 29.7%. And just so people who are listening know, we will, I'm going to go through these comments, and then at the end, we will go through all of the 28 objectives so that people who are listening can get it. And I'll also say that we will have a paper that'll hopefully come out the same day the podcast does that summarizes all the data and has the actual master list in there. Anyway, splitting it by questions. This was very interesting because if you think about the purpose of the study, it's really how can we elicit better objectives. And we, in the survey, we partially did that. We didn't have the master list in the survey because that's what we were trying to build. But we did have two different treatments in there, which was to double your list and the categorical, the categories to help people think about goals. So it was interesting to look at how people answered each question differently. By far the most common response to the first question, which was just, what are your goals, was financial independence and financial security. So kind of same as the overall data. In question 2, when people are asked to double the list, the prevalence of finding and affording engaging hobbies increased quite a bit. Financially supporting communities or causes that are important to me increased quite a bit. And maintaining physical health also increased quite a bit. So this is people sitting down, they come up with their first 2.7 goals on average. And then we asked them to double it. Then people kind of thought about these other things that might be important.
So that's before the PERMA V was added in at the third question, though.
Before the categorical, yeah.
That's interesting.
And in that second question, this one was also interesting. Almost as many respondents reported affording travel and leisure time with family in the doubling challenge as they did in the first question. So that, I mean, again, I'm not an expert in evaluating survey data, but it seems like that indicates that that is an important objective that people have, but a whole bunch of people that sat down to think about what their goals are initially didn't identify it and just asked them to double that list, which seems that this is an objective that's not universally, because not 100% of people chose it, but a majority of people find this to be an important objective, but a ton of people didn't identify it at first, and just saying double your list got them to do it. So then in the third question, where we did introduce the PERMA V categories, a lot more people articulated goals related to finding and affording engaging hobbies. Again, maintaining physical health, I think, was one of the biggest ones in the third question. Strengthening close relationships and giving time to causes that are important to them. So again, just interesting to see the progression of what people identify as important based on the prompts that they're given. But it does seem like those treatments or interventions, whatever you want to call them, that just asking people to double their list seemed to help. Giving people categories seemed to help. Of course, we couldn't test the master list because that's what we were building. But one of my takeaways from that is that and I guess we know this from the other research, but just saying what are your goals is massively deficient in identifying actual objectives.
Do you plan on going back to the people that participated in this survey and sharing the goal list to see if their goal count increases from the 6?
Well, we made it anonymous, so I couldn't. I don't know who the people are.
Yeah, that's true. How could we do? You need to know, though, what the final goal count would be once someone who went through the exercise goes and looks at the list of goals to see, well, where do you end up? Does it go from 6 to 10? Does it go to 6 to 8? Do the 6 change?
Would be interesting.
And follow-on question to that: have you thought about best practice for goal setting in a client advisor environment? Like, do you think it's best to go through the 3-step process?
That's one of our objectives with this tool, and one of the reasons that we wanted to have it is for that. Like, I think I've been talking to our financial planning team about this, that when we're onboarding clients, going through a process like this would be useful for the same reasons we've talked about. Like we may not have a good grasp, and people may not themselves have a good grasp of what their objectives are because they haven't gone through this exercise. And so now we'll have not only the empirically tested by these two other studies and by ourselves process for eliciting a set of goals, we will also have this master list to refer to as a final check.
It's interesting to think about, because if you give someone just a menu, say, "Oh yeah, I'll take that one. That one sounds good."
The master list is the last step.
Yeah.
And it's for exactly that reason, because people may be biased by it if it's the first thing that they see. And then the other thing that I think is we could continually iterate on this. Like if as we go through the actual process with people, maybe there are objectives that show up frequently that aren't on the master list and that we should add to it.
The other question that comes to mind is, will a better list of goals end up with a more inspired individual? And I would tend to think yes, because the more customized, the more reflects your true goals, whether you thought of them on your own or through a prompt. If you have better goals, I would like to think you're going to be more motivated to stick to the day-to-day activities that will lead you to that goal accomplishment.
Yeah. I think that's very probably true. We both read Chris Hadfield's book recently, and the way he articulates how goals can be used is pretty phenomenal.
Sure is. All right.
Chris Hadfield's a Canadian astronaut, if people don't know who he is. So I do want to touch on some of the limitations of this research. Like I mentioned, I'm not a I don't know what expertise you would have to do this properly, but I'm not that.
You're not it.
And then also in categorizing the goals, like in creating the master list of the 28 things that captured everything else. Again, not an expert there. I think we did a pretty good job, but not an expert. Also, the way the survey was designed, also not done by people with expertise in survey design or behavioral science or anything like that. So there could be bias in the way the questions were asked. And then the sample bias I touched on earlier, like this is mostly or largely podcast listeners. There were some people from the public who did it. There were like friends and family of Rational Reminder listeners. There were some PWL clients. There were some PWL employees in the sample, but the majority were podcast listeners. So there's going to be bias in there. We know that. My guess, and I don't have other than gender and age, which I think we do have from YouTube. But other than that, like my guess is that podcast listeners would be wealthier than average. We know that they're more male. We know they're younger than average. Probably more financially illiterate if they're listening to our podcast. So all those things introduce bias to the sample. But as I said earlier, it introduces interesting bias where it's like I would almost rather base my goals on the master list generated by that group than the one generated by the average population.
Correct.
Is that a bad thing to say? You cringed a little bit.
No, not at all. I'm just saying to me, that's good bias. You want people that have thought about this to contribute to the greater good, which is exactly what happened.
Yeah.
And if someone doesn't like the goals, they're not going to choose them for themselves.
Yeah. Yep. So anyway, we have now this final product. Like I'm looking at the table now. I'm going to go through them just so that it's there in the audio as a reference. So the most frequently reported goal category, or the category that most goals fit into, was being financially independent.
This followed is the first by one of 28.
Yeah, first one of 28. And these are in order of frequency of how many people in the sample selected that as one of their objectives. And we only counted each objective once. So if somebody in like question 1 and 3 identified something that fit into the same category, we only counted it once. Okay, so being financially independent, feeling financially secure, affording travel, leisure time, or experiences with family. That's the third one. Finding and affording engaging hobbies is the fourth one. That one was also more frequently selected by women than men, which is interesting. Financially supporting my community or causes that are important to me. maintaining physical health through sleep, diet, and exercise, assisting children with education costs and early adulthood setup. That one was interesting. It appeared a lot. That was 27% of people identified that as being important. Owning a home and affording its operating costs. And again, that was 25.8% of the overall sample identified that as being important, but 50% of one age cohort did. I think that was the only one where there were a few where there's a very obvious trend from across the age groups. Strengthening and maintaining close relationships, giving time to community and causes that are important to me. This one was interesting. Avoiding the hedonic treadmill, but not over-saving. And I put in brackets enough, like just having the concept of enough. That's something that came up in a lot of the responses. Financially supporting and protecting my family. Comfortably affording indulgences and luxury goods. That was another interesting one to see.
That's an interesting one to me.
Yeah. Yeah.
That will link to our discussion for the book review, as you and I talked about.
Finding engaging work and being in a financial position to pursue it. That was another interesting one where there were a lot of comments about wanting to find engaging work, but being in a financial position to take what may not be the highest paying job available to you, so that you can do work that is engaging, I think is how I would. So a lot of responses fit into that sort of theme.
A wonderful goal.
Yeah. Having ownership of time. And I think that one, like, I don't know, that was somewhat of a catch-all for, because there are other ones that are specific about like having time for hobbies or having time for family, but yeah, I guess there were enough that fit into just general ownership of time. Gaining knowledge and learning. That was another neat one to see, where a lot of people talked about finishing a degree or going back to school or taking courses or whatever. Leaving a legacy came up a lot. So that's like leaving money to heirs. Accomplishing personal successes. Paying off debt. Having time to spend with loved ones. Owning a cottage, vacation property, or land. It was interesting to see the amount of responses that were just about owning land. Like, I just want to own land just so I can have it.
So that one is much lower than I would have guessed.
Owning a cottage?
Yeah.
8% of respondents, more than twice as many men as women identified that as being important. So almost 10% of men and 4.2% of women. Spending time in nature, outsourcing unpleasant tasks, which again, that's kind of related to ownership of time, but just in some cases, people were very explicit about outsourcing unpleasant tasks, and there were enough responses that it warranted a category. Starting a business, that was another interesting one that came up a lot, more than I maybe would have guessed it would. And I think probably that relates to financial independence. I think just based on my reading of those responses that related to starting a business, it was largely about engagement and accomplishment, but largely about freedom as well. So, like some of these might collapse into each other, but again, I don't feel like I have the expertise to really evaluate that well. Gaining or maintaining financial literacy. That was another interesting one that came up more than I maybe would have guessed as a financial goal. And there were even ones in there about like goals about understanding risk tolerance, like understanding my own risk tolerance. So that ended up in the financial literacy bucket. Even like understanding portfolio theory so that I feel more comfortable sticking with my strategy. There's a bunch of interesting responses like that. Raising financially literate and responsible children. That was another interesting one that came up quite a bit. And the least frequently reported, but still frequent enough to make it onto the list, was maintaining balance between work and other aspects of life.
Wow.
That's it.
What a great list.
It is pretty cool. It is pretty cool. So that's it. That's the end result of the fairly significant undertaking that we did to conduct that survey and process the data. And as I mentioned, there will be a paper, hopefully the same day that this podcast episode is released, that kind of summarizes the survey and the thinking behind it and the results.
Awesome. Love it. Great work. Okay, ready to discuss this week's book?
Let's do it.
And I think this is a good topic that you and I can really discuss as opposed to just me talking about a book. So this one is called The Next Millionaire Next Door, Enduring Strategies for Building Wealth by Thomas J. Stanley and Sarah Stanley Fala. And many people have likely read the original book, which was The Millionaire Next Door, which was published in 2018. Sorry, published in 1996. That was the original book. This book was published in 2018. So there's a big gap in time between there, and a lot has happened in the world from 96 to 2018. I remember reading the original book. It was wildly popular back in the 90s, especially in like the financial advisor arena. Pretty sure most advisors read it. Many clients read it. And I just think back to that original book, and the key lessons are pretty simple, right? Live below your means. Assets matter more than income. Ignore how your neighbors spend. And basically slowly and deliberately build your financial independence over time. Be very deliberate about it. And the punchline of this book is that not much has changed in that time between the two editions. So this book was started by the same author, Tom Stanley, and his daughter, Sarah Stanley Fala. Unfortunately, the father was killed by a drunk driver in 2015, literally on the eve of when the first wave of research invites went out. So his daughter carried on with the project. She's active in the industry, and very credentialed family. Dr. Tom Stanley has a doctor in business administration from University of Georgia, and basically spent most of his career trying to understand how a wide range of American millionaires became millionaires, which is super interesting. Mm-hmm. And then Dr. Sarah Stanley Fala, his daughter, got a doctorate in psychology from University of Georgia, and in 2012 became interested in the academic perspectives, as she puts it, of personal finance. So she carried on the work of her father before and after he passed away, and with the same objectives to find out what are some of the traits of high-income earners who were better able to transform their income into wealth. And again, you got sample bias going on here, of course, and they're quite clear about not suggesting causality. It's just these are just observations of people who happen to respond to the survey who were millionaires. So, and there's all kinds of chatter online about the quality of the surveys and whatnot. I don't really want to get into that, but I think there are some interesting takeaways from the sample and the writings that they did do. Clearly, you need a certain amount of income to be able to become a millionaire. They do talk about that and some of the issues in society these days, like income inequality and concentration of wealth. And what's one of the stats? Like 54% of Americans, if they had an expensive $400 come up, they would have to either sell something or borrow. So they do acknowledge that this study is not about everyone. It is about people who happen to amass $1 million. So the data in this new book came from surveys that they did in 2015 and 16 with people greater than $1 million of net worth. So the survey is detailed in the book, but they did receive 998 responses with a response rate of 9%. Some responses were not complete, so they ended up with 834 responses in the survey.
Not a huge sample.
It's not a huge sample. And again, this is part of I know you shared with me a Reddit thread, and there's chatter, kind of you poke around on a Google search around the quality of the survey. Again, I'm not a survey expert like you, similar to you. Neither of us are experts in this. I'm not passing commentary on that, but I do think there are some good lessons that come from this. And yes, it is survivorship biased. It is also biased in terms of who responded, but there's still some neat things there. So, bottom line, what are some of their habits? So some of the data around this survey and about Americans, 9% of households in the U.S. in 2018 have a net worth of greater than $1 million. It It was 3.5% in 1996. I do not believe that inflation was taken into account, though. I reread it this morning, and they said the equivalent in 2018 would be 1.5 million, but I don't think that was a cutoff in the survey. Okay. The median net worth of all Americans in 2016 was $97,000. The mean was just under 700,000. When you exclude real estate, the median net worth of all Americans drops to $25,000. So now I'm going to switch to the survey. So in the survey that they did, of the American millionaires, so here's a list of the characteristics. 70% state that they've always been frugal. And that is the theme that comes through the whole book and the first book. Some would argue that the first and second book are extremely similar. 91% rated being disciplined as an important success factor. Only 32% said their parents were better off than those of their high school classmates.
Self-reported, though, right?
Correct. 80% were self-made millionaires. Only 10% had received any inheritance or gifts. 93% have a college degree. 20% are retired. Those that are working work on average 45 hours per week. The most frequent professions of the millionaires: business owners, lawyers, engineers, managers, physicians, consultants. Most did not become millionaires until late 40s or early 50s. More than 70% know their personal expenses. 77%, and I would guess you'd be in this bucket, Ben, had not participated in Black Friday shopping in the past 5 years.
Oh, yeah, I'm in there. No thanks.
And this one, well, the median amount paid for their most recent car purchase was $35,000 US. And they tended to drive Toyota, Honda, or a Ford that is greater than 3 years old.
You say that because I bought this book probably a year ago because I used their data in the Finding and Funding a Good Life paper on the section on luxury vehicles.
They also said the majority do not live in, quote, fancy houses. The market value of a home is less than 20% of the net worth on average.
That's an interesting data point. I get that question a lot. What percentage of my net worth should my home be?
There's a piece of the sample. Very low amounts of debt. Debt equals the equivalent of less than 5% of net worth. In terms of charity, 36% give 5% of their income annually to charity. 25% give 10% or more to charity. Time spent on selected activities of millionaires versus the American public. They read more for pleasure per week, 5.5 hours versus 2. They spend much less time on social media. Now, this is a number of years ago, but still 2.5 hours versus 14 for the average American public.
14 hours per week on social media?
And it's got to be more than that now.
Wow. Oh, yeah, per week.
This is like 4, 5, 6 years ago because they started the survey in 2016, right? That's per week. They exercise more, 5.8 hours versus 2.5.
I bet you that social media time it has at least doubled.
Yeah, I forget the numbers. We talked about that when we reviewed Johan Hariri's book, Stolen Focus. I don't remember the data. But this links back to why I was highlighting that goal that you mentioned about, being able to purchase, was it luxury goods or
comfortably affording luxury goods?
Luxury goods. And this is another big point they keep talking about in the book, is the ability to ignore your peers, your neighbors. And they said, like, where you live has a huge impact on how much you spend because that's who you typically are around. And they also alluded to, different professions where certain professions may have a kind of an image of spending more on certain things. So to be very, very aware of the impact of who you're around. Another one here that's interesting, millionaires sleep, I would say much less, 53.6 hours per week versus 61.5. Super interesting commentary in the book around financial advisors, and they actually dedicate a whole chapter to this, and I went back and reread that chapter this morning. So less than a third rely, so this is the sample, less than a third rely heavily on a financial planner. Most millionaires surveyed spend 1% of their annual household income on financial advice. So not assets, like not an AUM type fee, but of household income. But 1/3 pay nothing. 70% say they know more about investing than most financial advisors. However,
unfortunately, that's probably true.
Like, because you got to buy a sample here. Of course, much like the Rational Minder Group, you got a pretty keen sense of people, and there may be bias in actually who, accepted to be part of the survey. But the author did spend a great amount of time about how the role of the financial advisor has really shifted since the original book was written, and that a good financial advisor can play a very important role in helping people learn how to accumulate, how to set goals, and behavioral coaching.
That does line up with the topic we talked about earlier with the goals survey.
Which was a total fluke.
Yeah.
So it said there's huge value in that. And, with the right support, many more people could have the ability to convert more income to wealth. They're also big proponents of diversified, low-cost, indexed portfolios. Another thing that they use, which I thought was an interesting rule of thumb, is what they call the expected net worth test. So a lot of this data came from comparing, once you're in the millionaire cohort, they would compare how much you had of net worth to what was their expected net worth. So the expected net worth is your age times your income divided by 10. Okay? So if you say the average millionaire in the study was in their 60s, the average income was $250,000, which is true. So if you just do that math, age 60 times 250 divided by 10 is $1.5 million. So if your expected wealth is $1.5 million, they then put you in quartiles depending on how much more than expected you had, and able to do comparisons between different quartiles. But I thought that metric is an interesting rule of thumb for people to use as they go through life.
What's it based on, though?
That I don't know. I could not find that. It's just something that was used in the original book that they carried through to this book.
Okay, interesting. But
But it's basically saying that if you live below your, if you're frugal, live below your means, live within your means, and save the difference, you're going to accumulate wealth. It's that ability to accumulate as much as you can over time. I assume there's some math behind this formula.
So it's like a rule of thumb, basically, where they're saying that if your net worth equals or exceeds your expected net worth, you're probably in good shape.
Well, look, the average millionaire in this survey had a net worth of $3.5 million. If the average one was 60 years old making $250, you expect them to have 1.5. So the average one, I take away from this, has almost double what the rule of thumb would have expected or suggested.
Interesting. I just want to know what the rule is based on.
Yeah.
You're doing well based on this arbitrary rule. Good.
So when the author was asked if people with high incomes today are better at accumulating wealth than those from 20 plus years ago in her father's original book, her answer was not really, is the clear answer. Most high income producing couples in general are more of the income statement affluent types than the balance sheet affluent types. So as I told you this morning in our Teams chat, I mean, the review of this book is actually quite simple. Spend less than you make. Avoid social influences to spend more. Pay attention to your finances or hire someone to do that. Target a net worth of age times income divided by 10 and just keep repeating it over and over and over.
So similar to lessons of the original, right?
Exactly. And that's by far the commentary that you see online. I enjoyed the book. Great timeless lessons.
Cool.
So there we go. Shall we jump into some of the very kind letters, messages that we've gotten lately? In fact, we got a nice letter from a director at a firm here in Canada. Do you want to read it, Ben?
Like read the whole thing?
Well, I think it's worth it. It's actually a very kind letter, and a lot of thought went into it. So,
you want to read the whole letter? Well, let's read like parts of it.
Fire away. Read what you like. How's that?
Okay. So they extend their very sincere thanks for the extraordinary content that we deliver to the world. And they've been listening for a couple of years, never miss an episode. And they often listen multiple times to make sure that they don't miss important content. They bundle the podcast listening with running. I'm forever motivated to get out for my weekend run just so I can listen to the podcast uninterrupted with a bit of extra oxygen to feed the brain. They endlessly adore us, which is very kind. I don't know how many people adore me.
Yeah, I guess we didn't need to read that, but okay.
You wanted to read the whole thing.
This is the back end of the episode. That's okay.
They can't imagine the void they'd experience without our weekly insights and interviews, etc. Unbeknownst to you, we've made a material contribution to their personal development and to the clients that they serve on a daily basis to the degree that they'd need a couple of hours simply to scratch the surface. And they've enjoyed the crypto series, which we talked a little bit about in the introduction. And that while it has admittedly fueled their confirmation bias, they've also learned a lot. The podcast has been a tremendous privilege and provided them to access to holistic insight across a very broad network of recognized experts. We're their favorite podcast, bar none. Yeah, I mean that was the gist of it. And then they offered a few topics that they would like to see us cover, which I've said like the last 3 episodes that I wanted to put more thought into this before we talked about it, and then we decided that it was taking me too long to do that, so we're mentioning this now. But I still do want to get in touch with this person and talk about the topics that they want us to discuss. So maybe we'll save that part of it, and we can actually have this conversation with this person and then talk about it on a future episode.
Yeah. Thought her comment too about the fact that we tend to cover so many topics that they didn't know they needed to know until we brought them up. And that's kind of the organic nature of how ideas come up, because we're just kind of scouring all over the place for different things to consider.
I got to say, their comment about, like, I was at the conference that I talked about a while ago and met a bunch of people there who said similar things to this, that they learned so much from the podcast and they enjoy listening, and it's a primary source of direction for research that they want to do on their own. Like, I don't think people use our podcast for primary research because it's, we just talk about stuff and give overviews of stuff, but it gives people direction in terms of what research they want to dig into more seriously. But the comment about if we stopped, it would leave a void, that well, I wouldn't say it stresses me out, but it's something that doesn't make me nervous. I don't know how to describe it.
Can you imagine a void in our lives?
Well, yeah. Would it be a void, or would it be just a whole bunch of free time? I don't know. Might be a void. Might eventually be a void. But I do think about that, because I know that if there's a podcast that I listen to every week religiously, and it's like something I look forward to, if it goes away, that's a terrible experience.
Yeah.
Anyway, so that comment,
maybe we'll be able to do what Joe Rogan did last week, which is have AI bots create this podcast going forward.
Did he do that?
He did that. I haven't listened to it yet, but apparently it's quite something.
Like a whole episode that's AI generated?
Yeah.
Like there's no humans talking?
Apparently not. That's what I've heard. I haven't listened to it yet, so I stand to be corrected. I heard that yesterday afternoon.
I don't know if AI generated financial advice content would go over very well.
I don't know. Next one we got was a typed letter in the mail at the office. So this person said we can share the story. So this is a really good story. Someone who's from the U.S. and said, kindly oblige me for a page or two. I'd like to tell you a short story. Anyways, this person, full-time out of school professional job as a structural engineer, and like Ben, majored in engineering for undergraduate, born poor from outside the realm of finance, and was totally ignorant of finance, could not fathom how money now turns into more money later, and it's always sounded like gambling. Got a 401k and had no idea what it is or how it worked. And the brokerage account, which was managing the 401k, did us some allocation guides based on risk tolerance, but didn't understand what any of it meant and didn't know what to do or how to choose a better allocation. So in late 2020, when they had a period of time at home, they searched online for information about investing and started at Investopedia. and then took pages of notes trying to figure out what was the difference between a mutual fund and an index fund, and could discern that a lot of the informational channels for personal finance were bad just because it reminded me of some peddler or salesman. Was still a professional engineer, good with numbers, and knew that there had to be some solid mathematical spine to investment decisions. I suspect that resonates with you. Came across technical analysis at some point in the research and did not need to watch this person to come to a similar conclusion that he has. Anyway, so the search continued, came across on Reddit your upvoted YouTube channel, which is pretty cool. In retrospect of knowing the content.
No, they said in search of some basic Reddit information, in some hardly upvoted comment, was a mention of my YouTube channel. I think they're saying it was like a fluke that they saw it.
Oh, wow. So in retrospect of knowing the content of your channel, the low upvote count was probably because I was lurking Wall Street bets at the time, which is pretty funny. Anyways, it was entertaining and there was some useful information there. You just had to watch where you stepped. The link was a diamond, so to speak, and the first video of Ben's that I watched was one of the more recent uploads at the time, and it was about the Fama-French three-factor model. Loved the reference to academic literature and the matter of fact in your speech. There were no extreme certainties or promises, which was refreshing. Anyways, eventually searched expense ratios of the funds in his 401k and reconfigured allocation of a globally diversified portfolio of low-cost index funds. However, that's not where the story ends. After listening to the podcast, I came to admire the way that we discussed our professional and personal lives, and I've had a passion for helping and teaching others about topics I found to be difficult yet important too. And I hope to one day be able to do that on a daily basis, whether it be for engineering or finance. I like engineering and enjoy my job, but I found a pivot into finance to be both feasible and optimal for my professional development. By early 2021, I decided to pursue an MBA and began to study for the GMAT entrance exam. 3 exams and 10 months later, I got a score found to be acceptable and began applying to various programs. By March 2022, so this spring, after many applications, essays, and interviews, I was offered admission into several of the top programs in the United States, and by April, I accepted a full-time MBA into the Booth School of Business at Chicago. Courses just began last month. How's that for a cool story? Very
Unreal.
Appreciative, and wanted to pass that along in a letter to us. How cool is that?
See, this is what I'm saying, though. That, you know, not just the void that we would leave, but like we're talking to each other and we're talking to other people, and it's shifting the direction of people's lives. That's wild.
Well, listen to the next one. I don't know if I told you this story or not.
Oh, come on. You're killing me.
This is another one. So, and pardon, but this is the back end of the show. If someone's uninterested, they're long gone anyways. But I think this is a really interesting story. So I talked to William, reached out on LinkedIn, I think, and talked to him last week. Longtime listeners, many of his friends are also. Really enjoys our book reviews, and in particular mentioned our interview a couple, I guess, 3 or 4 weeks ago with David Senra, who's the host of the Founders podcast, and he loves founder stories. So he thanks us for inspiring him to get into reading again, reducing his video game, and gaining appreciation for avoiding the addictive interruptions of his phone. So the interview, or the book review we did of Stolen Focus back in episode 193 had an impact on him. So get this, he took the founder's concept with the need to avoid interruptions from the phone, put them together, and is creating a product. I don't want to get into what the product is for privacy, but a super cool product to help people avoid phone interruptions. How neat is that? Super cool to talk to William last week. Another LinkedIn message I got from Mark in Woodstock to thank us, for the podcast, and also thoughtful analysis on how to live a decent and meaningful life. Been listening since early 2020 and learned about your common sense investing videos on YouTube. At the time, his investments were at his bank's dividend mutual fund. After listening to the podcast, all the savings have been moved over to a single all-in-one globally diversified index portfolio. He's read a bunch of books on finance since then and just reinforced his confidence. So that's all very cool. Outside of investing, the podcast has played a big part in teaching him that money is ultimately only the means to an end and living a decent and fulfilling life. Had some comments for us. Loved the book challenge. Listens to us on Google Podcasts. Unfortunately, no option for leaving a review there. But if there ever is a chance to do that.
You left out a big piece of it. Maybe you did that on purpose. Did you?
Fire away.
They based on outside of investing, your podcast played a big part in teaching me that money is ultimately only a means to an end and living a decent and fulfilling full life. To that end, they left a job that they were unsatisfied with, took a 4-month career break, and then pursued work that was more meaningful to them. And they ended up making a higher income by doing that. See, that's again, we're shifting the directions of people's lives. That's like it's intimidating or something. I don't know what it is. I guess we do that professionally, maybe to an extent too. So maybe it shouldn't be. It just seems different with internet strangers.
And the last one, get this. This one is, for me, pretty impactful. So I was, everyone knows I went to Ireland with Lisa earlier this summer, and Steve from Calgary reached out. And I'm not a big fan of giving travel tips because I know they kind of drive people crazy. But he said, I exchanged some ideas with him of where to go. Just 3. I said, I don't want to drive you crazy with it. So I gave him a few ideas where to go. And as he was heading off to Ireland, so get this, he sent me a note and said, my wife and I just returned from our visit to the coast of Western Ireland, which is where I suggested he goes. I don't know if he was going there before or not, but it's unbelievable. Anyways, just returned from our visit to the coast of Western Ireland. Incredibly beautiful place and people. Unfortunately, while there, back home, my mother got ill and died, so we returned home 3 days early. As sad as that was, we found ourselves surrounded by extraordinary people during that vulnerable time, which will always be a part of me. For example, Tom McHugh was gigging at McCafferty's Donegal. He said he would be honored to play his favorite Irish folk song for his mom. It was intimate and personal with a few locals singing along. I wanted to share it with you. So he sent us the YouTube video of this performer doing this song in a pub in Ireland. So he said that I could share this note and also share the YouTube link. I tell you, it brought me right back to being in Ireland. It's incredible. You can feel like the Irish feel of the pub, and the music is just, it's incredible. So for those interested, you can check out the link in YouTube.
It's blowing my mind right now. It's, I think about this. I think about this, but it's these things. Reading these things is making it just more explicit. It's like I mentioned this with Chris DeRose too, where I had this feeling. Chris DeRose is one of the guests we have for the crypto podcast. I had listened to hundreds of episodes of their podcast, and you create this like weird asynchronous relationship with people. But you see that in these things where there's all these people listening to our podcast and they have a relationship with us, but we don't know them. It's weird to think about.
But it's gone on for so long, right? Like I was listening to a Kara Swisher interview this week, and she talks about the power of this medium, right? It's been happening in radio forever, right? Like you felt you knew the DJs. Like when I grew up, you knew the DJs.
Right.
Well, it's just an evolution of mass communication into more micro customized communication. It's like you have even more, like people who are listening are even more engaged with the content of the subject matter and the material.
That's what I mean. It's different. It's different from a radio DJ. Like it's more niche. It's more targeted. It's more intimate, if that's the right word to use.
For sure. I think it does put creative pressure on us.
That's never been an issue. The creative side.
Well, I'm always amazed. Like we have this week, for example, how many pages of notes do we have? 16 pages of notes. That kind of comes together in the 3-4 days before.
Yeah, I don't worry about the creative side. I don't know. I can't tell you where the ideas come from, but they keep coming. Like we had the topic for this week done last week, and then I ended up doing the goals because we finally finished processing the data. So I threw that paper together, and we ended up doing that this week, which means we already have next week's episode, the meat of it, written. And I've got like 3 more ideas. So that the creative pressure has never been an issue. But there's a weight of sorts, knowing that there are people listening to us and altering the course of their lives based on that. Like, really? You guys sure you want to listen to me?
That was fun. Anything else?
Nope. I don't think so.
All right. Thanks everybody for listening. We really appreciate listening and connecting with you.